What you're looking here are the 503 stock symbols that make up the S&P 500. S&P stands for Standard & Poor's, the company that created and maintains this benchmark. Despite its name, the S&P 500 actually tracks 503 stocks because a few companies have multiple share classes included in the index. The S&P 500 is a stock market index that represents 500 of the largest and the most influential publicly traded companies in the United States. Together, they provide real-time snapshot of health and direction of the American stock market and by extension, the broader economy. Broadly, the companies can be divided into seven sectors, as you can see here, and the number you see on top are the number of companies that are present in the S&P 500 from these sectors. Now, in terms of percentage of the companies, this is how it looks, with manufacturing sector having the highest number of companies and real estate having the lowest number. Now here is an interesting chart. As you can see, year is on the x-axis and S&P 500 annual return is on the y-axis. So the annual return here means how much you would have gotten that year if you invested say $100. So in 2009, your $100 invested on 2nd January will have amounted to $125.94 with the $25.94 of growth. So looking at just 2005 to 2024, out of those 20 years, interesting patterns emerge. Only 3 years had negative returns. Most years stock went up. 2009 was a big rebound year after the 2008 crash. In 2018, stocks dropped from rate hikes and trade wars. In 2022, inflation, the Ukraine war, and bad bond returns crushed returns. So why did I make this video? Well, I came across this graph that really caught my eye and it got me thinking, how many companies actually beat the S&P 500 each year? That simple question pulled me straight down a rabbit hole and I dug deeper and deeper, even breaking it down by sector. And this video essentially shows my findings. So stick around. To answer the question how many companies beat the market, I checked if for each company its annual return was greater than the S&P 500 return. And I checked for the last 20 years. This is the graph that came out of that analysis. The black line shows the percentage of companies that beat the S&P 500 in a given year, and the gray line is the S&P 500's actual return for that year, the one that we saw in the last slide. What's interesting is that there's mostly a linear relationship between the two. When the S&P goes up, more companies tend to outperform it, and when it goes down, fewer do. But there are also some exceptions like 2015 and 2022. What is the reason? One possible reason could be that how I defined beating the market, basically any company that had a return higher than the S&P 500, even if that return was still negative. So in a down year, a company that lost less than the S&P technically counts as a winner. That might skew the numbers a bit. A cleaner version of this could be to exclude those marginal outperformers, maybe a topic for another video. Still, the overall trend surprised me. I didn't expect that in most years, 30 to 40% of companies actually beat the market. That's way more than would have guessed. The next thing that I asked myself is which sectors do these companies mostly belong to? Are the tech sector companies beating the market more than the real estate? And are there some trends there as well in these sectors over the past 20 years? That brings me to this next graph. What you're looking here is just the tech sector. Think companies like Microsoft, Apple, and Alphabet. On the y-axis, we have got the percentage of the companies beating the S&P 500 each year, and on the x-axis, the years. The line shows the trend over the past 20 years, and what stands out is that more and more tech companies are outperforming the market consistently. Now contrast that with energy and transportation sector, think ExxonMobil and Chevron. In these sectors, the percentages of companies beating the market has actually been declining over the last 2 decades. Finance, on the other hand, with players like Berkshire Hathaway and JP Morgan Chase, has stayed relatively stable. Not much change there, just a consistent trend over time. Now in life sciences, companies like Eli Lilly and Procter& Gamble are showing a downward trend as well, with fewer companies in this space beating the S&P each year. Real estate is also on a noticeable decline. Here we're talking about companies like Welltower and the American Tower. But in manufacturing, we are seeing a completely different story. There's a clear upward trend. So, American manufacturing seems to be holding strong and gaining market share. Companies like Nvidia, Broadcom, and Tesla fall into this category. And finally, trade and services are also on the rise. Now, think companies like Amazon, Walmart, and Visa and MasterCard, all leading the pack and consistently outperforming. So overall, looking at the past 2 decades, the sector with the highest percentage of companies beating the S&P 500 is manufacturing, followed by trade and services, and then technology. But just to clarify, this analysis includes all companies that outperformed, whether they barely edged past the S&P or absolutely crushed it. So yes, there are outliers on both ends. A more refined analysis, removing those marginal cases or extreme outperformers is definitely something I plan to explore. That said, this has already been a really fascinating deep dive, and in the next video, I'll take this one step further. By how much do these companies actually beat the S&P 500? We'll calculate outperformance. So for example, if a company returns 15% and the S&P returns 10%, that outperformance is 5%. And that's it for this one. Check out the description below. You'll find the link to download the full list of companies I analyzed, and obviously do subscribe and like it if you enjoyed this video. See you in the next.